Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Ondas.
If you find our talks useful, please consider subscribe, like, and comment underneath.
Because today we really need to dig into a company that is just, well, it's completely breaking the standard rules of wealth building.
Yeah, I mean, typically, if you're evaluating a stock for your portfolio, you want a really clean narrative, right? You want to see revenue scaling up, cost tightening, and, profit margins expanding. It's a comfortable equation.
Right, exactly.
But today, that equation is it's shattered. We are looking at an incredibly massive financial inflection point here.
Yeah, it really defies standard categorization.
Right.
I mean, for anyone trying to navigate the modern markets, you have to understand why a company would, deliberately break that clean equation.
Mm-hmm.
We're talking about a massive transition. They're moving from a purely developmental tech portfolio into this scaled global operating platform.
Let's talk about the sheer scale of that trajectory, actually, because the growth metrics they're wild.
They really are.
Just in their autonomous systems segment, they went from generating, about $5 million in revenue to nearly $50 million in a single year.
Right, 2025.
Yeah, that is a staggering, almost 10x multiplier. It's 605% year-over-year growth.
It's explosive.
And then you look at just the fourth quarter of 2025 by itself, they pulled in over $30.1 million.
Which is crazy because they effectively made exponentially more in one single quarter than they did in an entire previous year.
Exactly. The acceleration is just violent.
And, the forward guidance completely builds on that momentum.
Yeah.
Management is targeting at least $375 million for 2026.
Wait, 375?
Yeah, 640% growth target.
Mm-hmm.
And they're projecting between 38 and 40 million just for the first quarter of 2026.
Wow. Okay.
And to support that, their autonomous segment backlog jumped from around 20 million to over 68 million by the end of 2025. So the demand is clearly there.
Okay, and this is where I have to push back a bit, because all of this growth brings up a glaring contradiction.
Oh, the balance sheet.
Right. Their balance sheet is unparalleled for a company this size. They ended 2025 with nearly $600 million in cash.
Yep.
And then they just turned around and raised an additional $960 million in net cash in January 2026.
Which creates a $1.5 billion pro forma cash position.
Right. So, and just to translate that jargon for you listening, pro forma essentially means as if. It's an accounting method combining past realities with immediate events. So they're sitting on a war chest of $1.5 billion.
Yeah. For a company at their current revenue scale, that level of liquidity is it's an absolute anomaly.
It is. And I'm looking at the $1.5 billion, and then I'm looking at their free cash flow, which is negative. They are completely unprofitable right now.
Mm-hmm.
So my question is this an actual strategic moat? Or are they just a cash-burning machine masking itself as a hypergrowth tech play?
That's the billion-dollar question.
Right, because sitting on that much cash, like a dragon guarding gold, but running a negative cash flow, looks dangerously like they're just overspending to look big.
I get that. And your skepticism is totally warranted. I mean, that's the exact tension institutional investors are struggling with. But you have to view that cash burn through the lens of modern defense procurement.
Okay, how so?
Well, the market for drone and counter-drone tech right now is incredibly fragmented. You've got hundreds of small startups with brilliant ideas, right?
Sure.
But they have absolutely no capital to scale. By hoarding $1.5 billion, Ondas is basically weaponizing its balance sheet.
Weaponizing the balance sheet.
Exactly. They are aggressively investing in heavy manufacturing, global supply chains, go-to-market infrastructure. They are purposefully burning cash to outspend weaker competitors.
Oh, I see.
Yeah, they're suffocating the fragmented market by building a scale that a smaller startup simply can't match.
Right. Okay. But building a massive cash pile and outspending the little guys is only half the equation, right? The real question for you as an investor is how they deploy it without just, incinerating shareholder value.
Exactly.
To justify a $375 million revenue target, their hardware has to do something fundamentally different than just flying a camera around in the sky. They aren't just selling individual drones, are they?
No, not at all. They are building an inescapable ecosystem.
Okay, explain that.
The strategic shift here is moving away from selling single hardware units and aggressively going after higher margin integrated system of systems contracts.
System of systems. That reminds me of the classic Apple ecosystem lock-in,
Yeah,
right?
perfect analogy.
Like, you don't just buy an iPhone. You buy the phone, then the smartwatch, then the cloud storage, the wireless headphones, and before you know it, the switching costs are so high that you're just permanently trapped in their environment.
Right.
Is that what they're trying to do here? Build the iOS of battlefield robotics?
That is highly accurate, actually. Because think about it. A single drone is just a localized sensor. But a system of systems takes that aerial drone feed, merges it with ground-based robotics, filters it through counter-drone radar,
Wow, okay.
and then it feeds all of that data into an AI-enabled command and control center.
Yeah?
You aren't buying a drone. You're buying the eyes, the brain, and the nervous system of the battlefield all at once.
That sounds incredibly powerful, but, and here's the catch, getting massive government agencies, defense departments, heavily regulated industries to adopt a completely new ecosystem. That usually takes decades.
Oh, for sure. They are notoriously slow.
Right. So how are they forcing this adoption so fast?
Well, they're leveraging compliance and strategic partnerships to essentially just force the door open. Let's look at the manufacturing side first.
Okay.
They've built a massive regulatory moat by scaling up U.S.-based manufacturing. So facilities like Detroit Manufacturing Systems and Kitron.
Mm-hmm.
This specifically ensures their entire supply chain is NDAA compliant.
NDAA, so the National Defense Authorization Act.
Yes. And the mechanism of that compliance is vital. If a drone contains even like a single non-compliant microchip manufactured by a restricted foreign adversary.
The U.S. government legally can't touch it.
Exactly. A foreign competitor could have the most advanced drone on the planet, but without NDAA compliance, they are permanently locked out of billions in homeland security and defense contracts.
Wow. So they just built a legal wall around themselves that instantly disqualifies most of their competition.
Yes, on the hardware side.
Right, but hardware is useless without the software to interpret all that data. And military branches don't want to learn a whole new operating system just to fly a new drone, right? The friction there is huge.
Which is exactly why their strategic partnership with Palantir Technologies is the linchpin of this entire operation.
Palantir, okay, that's huge.
Yeah, they are deeply integrating their intelligence and sensor roadmaps with Palantir's AI platform, specifically the AIP, Maven, and Foundry systems. So think about that friction of adoption you mentioned. If a military unit is already using Palantir's software as their central nervous system, and this new hardware natively plugs directly into that exact interface.
The barrier to entry just drops to zero.
Exactly. They're basically piggybacking off of Palantir's existing dominance in defense software.
That's brilliant. They don't have to sell the software platform because the military already bought it. They just provide the ultimate peripheral device.
Right.
But this strategy isn't just limited to defense, is it? Let's talk about their networks division.
Oh, the railroad stuff, yeah.
Right. They recently won the Association of American Railroads selection for their IE 802.160 protocol, which honestly sounds incredibly dense.
It does. It really does.
But from what I understand, they basically secured the entire upgrade path for the 160 megahertz network, right? The next generation head of train and end of train system.
Yeah, let's translate what that protocol actually does in the real world. Modern freight trains are no longer just, hunks of metal dragging cargo. They are rolling data centers.
Right. They need constant data.
Exactly. Continuous, real-time data for automated routing, remote diagnostics, preventing crashes. That IE protocol is basically the foundational language that all those sensors and automated braking systems will use to communicate.
Oh, wow.
So by becoming the selected standard for the entire American railroad system, they become the invisible track that all future rail data runs on.
And once a national industry adopts your protocol as the baseline standard, you are entrenched for a generation.
Completely entrenched.
But, okay, taking a step back here. This requires inventing best-in-class drone tech, counter-drone tech, AI sensor integration, and national railroad protocols all at the exact same time. You can't organically innovate all of that overnight. The speed is suspicious.
Right. You can't build it organically. Which brings us to, honestly, the most dangerous part of their strategy.
The roll-ups.
Yes, they rely heavily on aggressive mergers and acquisitions. They aren't building everything from scratch in a lab. They are buying their way into these ecosystems.
And this roll-up strategy introduces massive execution risk. But more importantly for you, the retail investor, it introduces severe shareholder dilution.
Massive dilution.
Let's focus heavily on that because this is the single biggest risk if you're holding the stock right now. Acquiring companies using your own stock as currency is literally like printing your own money to go shopping.
Yeah, it actively devalues the existing shares.
Exactly. I mean, they've raised over $1.8 billion in gross equity proceeds since June 2025.
It's a staggering amount.
The recent Mistral acquisition alone used over $122 million in common equity.
And, the complexity of what they are trying to stitch together is just an operational nightmare.
Right, integrating all these different companies.
Yeah, they're integrating Aerobotics for automated drone boxes, American Robotics, Sentry CS for counter-drone tech, Mistral, and Worldview.
Wait, Worldview, those are the stratospheric balloons, right?
Yeah, high-altitude surveillance platforms.
Yeah.
But imagine trying to unify 5 different engineering cultures, 5 different software architectures, and 5 different global supply chains. The friction is immense.
And the SEC filings are just relentless. We are seeing a continuous registration of shares for resale, which creates this massive overhang on the stock price.
Definitely.
Let's just look at the timeline. There were almost 2 million shares registered for Sentry CS stockholders on March 26th.
Yep.
Then over 2.3 million for Worldview on April 17th, and another 1.5 million shares filed just on April 24th.
Right.
If all of those previously locked up shares flood the open market simultaneously, the supply massively outweighs the demand and the price just crashes.
And this is where that massive $1.5 billion cash runway becomes their primary defense mechanism.
Oh, how so?
Well, in a complex M&A roll-up, cash buys you the most critical asset time.
Okay, time to integrate.
Exactly. They have the capital to absorb the operational friction of integrating these companies without needing to panic raise even more cash just to keep the lights on.
That makes sense.
Furthermore, they've really insulated the execution risk by bringing in incredibly high-caliber defense leadership. You've got Brigadier General Oshri Lugassi stepping in as co-CEO of the Autonomous Systems segment,
Right.
and Major General Yoav Har even joining the advisory board. Institutional investors look at that and realize, hey, this isn't a group of Silicon Valley software developers trying to guess how military logistics work.
Right. These are individuals who have actually deployed multi-domain defense systems at scale in active combat environments.
Precisely. It builds a ton of institutional confidence.
It does. But I want to dive into the physical mechanics of the stock market for a second to address that share overhang, because there's a specific structural protection built into some of these deals, right? Like the Worldview registration.
Yes. The trading limit?
Right. It includes a trading limit where the sellers can only offload 5% of the prior day's trading volume for 6 months.
Okay.
In practice, with a stock experiencing wild daily volatility, does a 5% limit actually stabilize the price, or does it just create a prolonged, slow bleed?
Well, think of daily stock market volume like a highly pressurized water pipe.
Okay.
Every day, a certain volume of water naturally flows through it based on standard buying and selling demand. If a major stakeholder tries to dump 2 million new shares all at once into a pipe that only normally handles 1 million shares a day,
The pipe bursts.
the pipe bursts. The stock price collapses because there simply aren't enough buyers to absorb that instant supply.
Right. Okay.
What a 5% volume limit does is install an automated pressure valve. If the stock traded 10 million shares on Tuesday, the Worldview sellers are legally only allowed to sell 500,000 shares on Wednesday.
I see. It forces them to slowly drip their shares into the market.
Exactly. It allows the natural daily buying demand to absorb the extra supply without overwhelming the bid price. It prevents a catastrophic gap down in the chart.
It's forced volume absorption. But even with that valve in place, this fundamental battle between the massive contract momentum and the constant M&A dilution, it's playing out directly on the technical chart right now, isn't it?
Oh, absolutely. The volatility is extreme.
Let's examine that recent price action, because it's wild.
It's a textbook technical tug of war. We observed a massive breakout on Monday, April 20th, 2026. This happened right after the stock had established a firm technical base around $10.20 on April 16th.
Okay.
But the momentum didn't hold. The stock slid hard on Friday, April 24th.
And if you map that slide on the 24th against the news cycle, it perfectly aligns with the market digesting the realities of the Mistral acquisition and that brand new 1.5 million share registration.
Yeah.
This looks like a classic breakout and test structure. The stock shoots up on the euphoria of a new contract and then pulls back to test its new floor as the market mathematically digests the dilutive cost of that news.
Right. And what is crucial to monitor during these tests is the sheer volume. The average trading volume for this stock is screaming. We're looking at nearly 99.8 million shares trading hands on average.
Almost 100 million shares.
Yeah. That kind of hyperactive flow is not being generated by retail day traders.
Yeah.
That is massive institutional participation. The big funds are actively stepping in to buy the dips and absorb that share overhang.
But institutions don't buy into heavy dilution just to be generous. They are pricing in future catalysts. And the immediate catalyst seems to be tied to a $10 million initial order for foreign defense, right?
Yes.
Which is part of a larger $50 million demining award. How does demining fit into this whole system of systems approach?
It is the absolute prerequisite for the mega catalyst. That $50 million demining award is ultimately tied to Israel's massive $1.7 billion Eastern Border Security Barrier Initiative.
$1.7 billion.
Yeah. You cannot build the physical and digital infrastructure of a smart wall until you have autonomously cleared the environment of explosives.
Ah, right.
So the market is looking at Ondas securing the initial demining and sensor contracts, and they're projecting that Ondas is perfectly positioned to capture a much larger slice of that $1.7 billion pie as the barrier construction advances later in the year.
Which naturally sparks rampant speculation. I mean, there are rumors of a much larger prime contract award from that specific border initiative hitting before the end of 2026.
Oh yeah, tons of speculation.
Plus, we are seeing pending rumors regarding an expansion of the Onberg joint venture with Heidelberg to establish European manufacturing.
Right, which is huge.
If they start localizing their manufacturing in Europe the exact same way they built the NDAA compliance moat here in the U.S., that opens up an entirely new multi-billion-dollar continental defense budget.
The European theater is massive for counter-drone tech right now, just massive.
Okay, but this complex web of geopolitical catalysts mixed with heavy shareholder dilution has created a fascinating divide in how analysts are rating the stock.
Yeah, it's really split.
Let's look at the quantitative side first. TipRank's AI analyst, Spark, currently rates the stock as a neutral. It is heavily penalizing the company for its current cash flow issues, its unprofitability, and that inflating share count. However, traditional human analysts are rating it a strong buy with an $18 price target, and the technical momentum signals lean firmly into buy territory too.
Right.
So let me challenge you on that divide. Why is the AI analyst so cautious, while the human analysts are confidently slapping an $18 target on it? Is the AI detecting the true danger of the dilution that the humans are just emotionally ignoring? Or is the algorithm just missing the forest for the trees?
It's the latter. It comes down to an issue of temporal horizons. The AI model is highly quantitative and fundamentally backwards looking.
Okay.
It analyzes trailing metrics. It sees negative operating cash flow. It detects the mathematical inflation of the share count, and its algorithms automatically flag those metrics as high risk.
Right, logically.
Based strictly on the past 12 months of cash management, the AI is mathematically correct.
Yeah.
But the human analysts and the institutional technical buyers are looking forward.
Right.
They're factoring in the qualitative value of the Palantir software integration. They're pricing in the legal monopoly of the NDAA compliance moat. They understand the sheer scale of a potential $1.7 billion border security contract.
So humans can contextualize that the current painful cash burn is actually a deliberate, necessary strategy to secure future multi-billion-dollar monopolies.
Exactly. The AI just sees the fire, the humans see the forge.
The AI sees the fire, the humans see the forge. That is a phenomenal distinction. Let's synthesize this entire wealth-building thesis for you listening right now, because there are a massive number of moving parts to track.
Definitely.
We need to summarize the timeline, the risks, and the ultimate scorecard for the stock.
Right. So when we aggregate everything we've discussed, the hypergrowth anomalies, the brilliant regulatory and software moats, and then we balance that carefully against the aggressive M&A execution risks and the heavy shareholder dilution.
What's the score?
The final bullish score lands at a solid 7.5 out of 10.
7.5. Okay. And what is a target horizon for a play like this? Because given the friction of those M&A integrations, this certainly doesn't sound like a quick swing trade.
Oh, no.
Yeah.
It is absolutely not a short-term trade. This is fundamentally a 12 to 18-month hold.
Okay, 12 to 18 months. Why that specific window?
You need that extended time horizon for three specific reasons. First, you need time to capture the actual realization of that massive $375 million revenue target for 2026.
Right.
Second, you need time for the profit margins to physically improve as the heavy manufacturing actually scales up.
Makes sense.
And finally, you need to give the market time to fully digest and absorb the recent M&A share overhang. That 5% volume valve we discussed.
Yeah.
It literally takes months to fully work those excess shares through the system without crashing the price.
For you tracking this in your own portfolios, there are specific immediate milestones you need to watch. The first major test is the Q1 2026 earnings report coming in late May.
Yes.
Beating that $38 to $40 million target is absolutely crucial. If they hit or exceed that, it proves to the market that the aggressive roll-up strategy is actually generating top-line cash, not just, press releases.
Exactly. And you also need to watch for any official announcements regarding the European airport counter-drone deployment.
Right, the Heidelberg stuff.
Yeah. Securing those contracts will officially validate their expansion into the European theater and justify those manufacturing rumors.
Yeah.
The successful execution of those specific milestones is what will permanently transform this company.
Transform it from a highly dilutive, speculative growth story into a dominant, highly profitable prime contractor.
Precisely.
It really is a masterclass in the paradox of growth versus cost. We started by noting that evaluating this company requires throwing out the clean, comfortable equations we're used to.
Yeah, you really have to.
We are looking at a messy, expensive, hyper-aggressive strategy to build an inescapable system.
It's the harsh reality of the modern defense technology landscape. You either build the entire integrated ecosystem or you get completely locked out by the companies that do.
Which leaves us with one final, broader macro question for you to ponder as you evaluate this sector. As global defense budgets rapidly shift away from buying legacy, single-use hardware and strictly pivot toward these AI-driven, multi-domain autonomous architectures, will the massive legacy prime contractors eventually realize they are just too far behind to build this themselves?
That's a really question.
Will they be forced to simply acquire systems pioneers like Ondas at a massive premium? And if a massive legacy prime steps in to buy the whole company, does that effectively make all of this current share overhang entirely irrelevant? Keep an eye on those earnings in May.